Welcome to the 3-Minute Mandate. I'm Maxine. Today we are talking what if. Imagine you bought a rare baseball card for $10. A year later, everyone wants that card, and someone offers you $1,000 for it. You say no thanks and put it back in your drawer. You haven't made a dime yet, you just own a more valuable piece of cardboard. But in 2026, lawmakers in California, Virginia, and New York City want to tax you on that $990 increase right now, even if you don't sell. It's called a wealth tax, and it's the biggest shift in how the government treats your property in over 100 years. Is this the ultimate fair share fix or a legal glitch that could crash the economy? The issue is real versus unrealized gains. To understand this, we have to look at how taxes have always worked. Usually, the government only taxes you when you realize a profit, meaning you actually sell the card, get the cash, and have the money in your hand to pay the tax man. A wealth tax targets unrealized gains. California's proposed Billionaire Tax Act would take a 5% cut of a person's total net worth, their stocks, their art, their companies, on a single day, December 31st, 2026. Supporters say this is necessary because the ultra-wealthy don't live on income like you and me. They live on loans backed by their stocks, avoiding taxes for decades while their wealth grows into the billions. This tax is designed to unplug that loophole. But here is the pushback. Critics say this isn't just a tax, it's a forced sale. If a tech founder owns $1 billion in stock but doesn't have $50 million in cash sitting in the bank, they have to sell their company shares to pay the tax. When founders start dumping stock, the price drops, which can hurt everyone's 401k and retirement accounts. Then there's the exodus problem. We're already seeing it. In California, big names are moving to Texas or Florida before the January 1st snapshot date even hits. If the billionaires leave, they take their regular income taxes and their jobs with them, potentially leaving a massive hole in the state budget that the rest of us have to fill. To try to prevent this, California is proposing to have a look-back clause that effectively taxes someone the year prior to the law taking effect in December 2026, even if they've moved out of the state. The cleanup is this. The Constitution gives the government power to tax income, but taxing wealth is a legal gray area that is headed straight for the Supreme Court. If this passes, the government is essentially saying they own a subscription to your property. If they can do it to a billionaire's stock today, the logic says they could do it to your home's increased value tomorrow. The question is, does the government have the right to tax money you haven't actually made yet? Stay tuned for the results.